Hey, what's up everyone? My name is Ali. Welcome back to my world of stocks and welcome back to my 3 stocks on sale series for the month of May 2024, where in each episode I pick 3 new stocks that I feel are looking attractive at today's prices for the long term. To make it more fun and interesting, I also specifically choose one lower risk, one medium risk, and one higher risk option for some added variety. As always though, just please remember to do your own research and make your own decisions. I'm just showing you some stocks that I happen to like based on my own opinion, but we're all different investors out there, so you gotta find what's right for you. Anyway, regardless, I hope that you are enjoying this series, and let's not waste any more time because this is gonna be a fun one. I can't wait to share these stocks with you, so let's jump into it. All right, now starting first here with the lowest risk option. This month, I'm going with a giant that is about to announce earnings in the coming week, and that is Amazon, ticker symbol AMZN, which, look, normally I would try to avoid choosing a stock like this that is, about to announce earnings for this type of video, because even though I am a long-term minded investor who really couldn't care less what a stock does in the short term, I do sometimes get the occasional viewer that does care a little bit more about the shorter term. And so if I can avoid some of the huge swings from earnings on a video like this, then maybe I try to do so within reason. However, this time especially, it really doesn't bother me at all, because if Amazon shoots up on earnings, then that'll be great for me and the tons of other people that already own it. Maybe I'll look good with a video like this. But if earnings are bad, well, that's even better in my opinion, because I actually really hope, I'm always hoping that Amazon stock would crash into the ground so that I can take as many people's shares off their hands as possible and build my position out even larger. That's how much faith I have in Amazon stock long term. But sadly, I don't even think that's going to happen this time, because I actually think earnings will be pretty strong and the stock is already a buy before earnings for several reasons, and even after earnings too. Because first of all, you have to understand just what an already massive behemoth of a company this is, with well over $500 billion in sales every year, and is still somehow growing at a double-digit rate. It's absolutely incredible. And yet, that's not even the biggest reason why I'm bullish. What really excites me is their potential for profits, as currently their net income is only a tiny fraction of their sales at around 5%, but has been showing tremendous growth over the past 5 quarters, with operating income surging by close to 400% in the last 1 year over year. Free cash flow has also been skyrocketing, and with interest rates likely coming down next year, I think their profitability will only get stronger. And despite the stock trading near an all-time high right now, their forward price to sales ratio of around 2.5 is actually not that bad considering the huge profit potential. Of course, the biggest reason for that is because their cloud and digital advertising segments are both seeing higher growth than the totality of their business, which is still dominated by e-commerce. But cloud and advertising are hugely more profitable. And if they can continue growing like this, which I think the upcoming earnings will give us a better idea of, well, then profits I think will continue to rise as well. And that's why you see analysts projecting really high EPS growth above 30% on average over the next 5 years. Now, cloud is already very large and dominant as the market leader, but advertising is still relatively small on the global stage with only a single-digit share, meaning that there is plenty of room to keep growing there still. Not to mention that this quarter in particular is about to be, the one that's about to be reported, is the first one to include commercials on their Prime Video platform, which they launched at the start of the year. And while that may not sound like a giant game changer for them, at least not quite yet, I do think that it's a great example of how Amazon is finding new ways of not just monetizing their business more effectively, but also pushing further into advertising. And I'll sum Amazon stock up with this: seeing some of these other companies break north of $2 and even $3 trillion market caps, with Amazon still lagging behind them, just doesn't feel right to me. And as a long-term investor, I have more than enough patience and confidence to wait for them to join the club there too. So I am a buyer right now, and I will continue to be a buyer even after earnings too, regardless of how it moves the stock, but especially on any dips too. While Amazon has yet to report though, our medium risk option, stock number 2, has already reported this past week, and it actually fell quite a lot right after that, but I think it's a solid pickup on the dip, and that stock is going to be Meta, ticker symbol META, which I don't even really consider to be all that risky either, with how insanely profitable they are, doing tens of billions in free cash flow every year. However, Wall Street is more focused at the moment on their continually giant investments into AI and especially the metaverse, which this most recent quarter painted another scary picture of, as their Reality Labs segment that houses it only did 440 million in sales with over 3.8 billion in losses, bringing the cumulative amount since the end of 2020 up to now over $45 billion in losses. That's pretty staggering. However, I just continue to think that Meta can not only afford it, but that these investments will eventually pay off for them too. During the earnings call, though, the stock at one point had plunged almost 20% and lost around 200 billion in value, to which CEO Mark Zuckerberg commented on in real time, saying, "I think it's worth calling out that we've historically seen a lot of volatility in our stock, riding this phase of our product playbook where we're investing in scaling a new product but aren't yet monetizing it." And he cited past efforts like their short video service Reels that of course mimics TikTok, Instagram stories that mimic Snapchat, and also their transition into mobile. Anyway, it's a great point there by Zuck that I do agree with myself, because when you look at those other services and how they try to mimic other platforms, I mean there's even the new Threads mimicking Twitter now. Well, these are areas that may not show a lot of benefit right away, but over time they're absolutely crucial to an already giant company like Meta staying relevant within social media and digital advertising, which of course is where they generate the vast majority of their revenues from at around 98%. And so investing into AI and the metaverse may open new opportunities for them to maintain dominance and expand further too. I mean, they even have Meta Llama 3 and Meta AI to compete directly with OpenAI's ChatGPT. And in the earnings call, Mark talked about several other ways that they can use AI to improve advertising and even introduce new ways of placing ads too. I mean, think of it this way. McKinsey analysts project that the metaverse will be worth trillions in the future, and a gigantic reason for that will be due to digital advertising, which can easily be placed just about anywhere in the metaverse. Not to mention all the other ways that it can be monetized, like through online shopping or gaming, digital travel, learning, business, entertainment, and much more. And so one of the ways that Meta hopes to dominate this giant landscape is by licensing out their own metaverse operating system to third parties. This is probably what I'm most excited about myself as a shareholder for the future. Meta just recently announced that their Meta Horizon OS will be open to third parties like Microsoft, Lenovo, Asus, and more to help them accelerate their developments and build headsets and apps and everything else using Meta's own operating system. Similar to like how Microsoft licenses out Windows to other OEMs. And I just think this could be huge, guys. I mean, it's also drawing comparisons to like how Apple keeps their iOS for themselves for their iPhones, but Google actually provides Android for just about every other smartphone maker out there. And so if Meta can become like the Windows or the Android of the metaverse, I mean, the opportunities are going to be endless there. It's giant. Meanwhile, though, it wasn't even a bad quarter in my opinion, as they beat on both the top and bottom line while growing sales by $8 billion year over year and operating income from their family of apps by around $6 billion year over year, resulting in even higher operating margin of 38% versus 25% the year before. So outstanding performance and outstanding profitability, and yet the stock actually fell by double-digit percent this past week. I mean, I get that the stock is pretty elevated as it is, but with a PEG ratio more than 15% cheaper than the sector and over 26% cheaper than their own 5-year average, I think Meta is a very solid pickup on the dip. With that said, though, we are now down to the third and final stock. This is going to be the highest risk option of the bunch. And this time I'm going with another company that actually just reported earnings this past week. It fell a bit. The stock is down huge from the top two, and the dividend is sky high. So even though it's risky, in my opinion, I'm still buying more. And that stock is, of course, Verizon, ticker symbol VZ. who fell on earnings by around 5% and is now still hovering around the lowest levels of the past decade, down over 36% from the top. But with that massive crash comes one of the biggest dividend yields it's ever paid at close to 7%. However, the reason why I consider it to be much riskier than the rest is due to their low growth and massive amounts of debt that were greatly increased due to the investments into 5G and fiber and more. And this latest quarter showed a bit of a continuation of that, with lower sales than analysts were expecting as the macroeconomy struggles and consumers are choosing to hold on to their phones for longer periods of time rather than upgrade. And because Verizon is also known for charging higher prices than rivals like AT&T and T-Mobile, well, given the weak macroeconomy, you can see why performance might be lacking for a company like that. However, it's not all bad news. Verizon does usually charge a premium for good reason, as their services are consistently ranked the best in the world, and that strength showed in this quarter as well, as profits beat estimates and subscriber losses actually came in lower than analysts were expecting, thanks to new flexible plans and even partnerships with streaming giants like Netflix, Disney Plus, and HBO Max. Total revenue was also at least positive in terms of growth, even if just barely, with adjusted EBITDA rising a little too. Wireless service, though, rose 3%, probably the most important metric there, which helped offset the loss in business, probably due to macro conditions. And their investments into Fios and fixed wireless continue to pay off, with huge gains in subscribers on internet. Still, cash flow from operations was down a bit, but that too was also offset by a huge reduction in capital expenditures. That's because they don't have to invest as heavily into 5G anymore. What really concerns me though is how their dividends were barely covered in the quarter, with total debt still gigantically high, and that really does need to be paid off more. But from all the research that I've done, I gather that this was more of just like a one-off quarter that will see large improvements in the second half. The same thing basically happened last year, where they still ended the year with almost $8 billion in excess free cash flow even after paying the dividend, which they could then use to pay down debt. And this year should actually be even better given the guidance of a rise in sales, rise in profits, and also a decrease in capex. In the earnings call, management also spoke a bit more on this too, saying we are on track to meet our financial guidance and deliver positive phone ads this year. We're back to usual levels of capex as promised, and have struck a balance between profitable growth and free cash flow that supports both our dividend and a stronger balance sheet, giving us greater flexibility to accelerate paying down debt throughout the second half of the year and closer to our long-term leverage target. Our cash flow generation is solid, and it shows that we are executing well against our financial objectives, including supporting our dividend and paying down debt, with strong momentum already in the start of the second quarter. I'm confident in our ability to sustain progress towards unlocking Verizon's full potential for all stakeholders. And so again, what I like here is the beaten down stock, the dirt cheap valuation, around 30 to 50% cheaper than the sector, despite this being a market leader in both size and quality, and of course the huge dividend with a manageable payout ratio below 60% and almost 2 decades of consecutive growth. It is high risk though, because again, debt is gigantically high, and honestly, if we go into a recession, it really wouldn't shock me all that much to see a cut in the dividend, especially if it's a big recession. But at these levels, as a long-term investor, I'm kind of okay with the risk that I'm taking here. I know what I'm betting on, and it still feels worth it to me personally. Anyway, I'd love to hear your thoughts on all of this, everything we discussed today. Do you like any of these stocks? Do you own any of them? And are there any other stocks that you guys are buying? I'd love to hear about them down in the comment section. Maybe I can make videos on them in the future. But thanks again for stopping by, my friends. I hope that you're all doing well, and I will catch you in the next one. All right, take care, everybody. Bye-bye.